The inability of foreign capital to arrive here is an interesting debate, because we are of the view that capitalism sniffs out opportunities. If the valuation discrepancy is too high, capitalism finds a way to equalize those. It's what's perplexed us most about the bond market, because the bond yields have been so high in our country and so low in the rest of the world, and they haven't moderated. And again, there could be a litany of reasons for that. But ultimately, over time, we think that these arbitrages, for want of a better word, do get worked out. And if our valuation discrepancies to the rest of the world remain so wide, we think that there are levers to pull to unlock some of that value.
Well, here we are back in our Cape Town studio, and one of the locals, Andrew Vintcent. Where do you guys operate from?
Great to see you again, Alec. We're in an office in Constantia. There's a head office in Johannesburg, in Dunkeld, and I've opened up an office down here in Constantia.
So ClucasGray's is primarily in Dunkeld, excepting for Andrew Vintcent, who lives in...
Yes, and there's a small office as well in Somerset West, so we sort of scattered around a little bit.
Okay.
But with the Zoom economy, it's all working quite well.
When we last spoke, I saw that the Equity Prescient Fund was about 900 million. Now it's 1.1 billion. So obviously this is good. People are seeing you and saying, you want to give this guy more money to look after?
It's been a combination of a few things. I think the markets have been quite kind too. We've seen some what asset managers call beta. We've been thankfully we strive to get alpha in funds, but it also helps when the market goes up. So if we can go up slightly more than a market and the market is rising, it does help grow the asset base. But broadly speaking, I think the business has both funds, the equity fund and the equilibrium fund, which is a Regulation 28 balance fund, have had a reasonable couple of years and seem to be gaining some traction in the overall marketplace.
Well, you really helped us a lot in the BizNews model portfolio, because after our last conversation, when you made such a strong case for South African equities, saying they're on fire sale, we made some restructuring, and my goodness, they've performed well.
Yeah, some have. There's a bit of more added pressure now that you've told me that, but some certainly have. It's been a very interesting few months. If we go back to, we've been well placed with a number of our big holdings, and one of which we spoke about last time was Renewables and if we've been quite well served by some of those that have performed extremely well. But it's such a strange market in South Africa, given how dominant so many big companies are. I was reflecting on the way here on two particular months out of the last 4 or 5 months. I think it was October and January, where we had almost record month performances, yet we lagged the index by so much. And that's just the nature of this quirky industry we're in, that we try and outperform. Over long periods of time, we would back ourselves to outperform. And certainly the track record has demonstrated that over a sustained period. But over these discrete periods, it can be very difficult. You would have covered it extensively, the likes of Naspers or Richmond or the big mining companies really performing well. So it's been wonderful to see some of these undervalued companies, see some of the value unlocked. We still think there's somewhere to go. Just interesting how it compares against the overall index with these big heavyweights.
I was looking through the transcript of the last conversation we had, and there was only one stock that for some reason was put into the transcript, and that was Reunert. And Reunert's been a huge performer. You brought it into your portfolio and have definitely done well in your portfolio, given that it's what you call high commitment, 25 stocks only. We also put that into the BizNews model portfolio, and I think the business community thanks you.
Great. Well, it's good to hear. Look, I think we have referred to it in our last discussion as the fact that of all the issues the country's grappling with, load shedding at the time was one of the most pressing issues, I guess, and it's got more dramatic. It's got materially worse in the last 6 or 8 weeks, and yet some of the cure for the issues the country's been grappling with is fixed capital investment and a growth in the renewables. And this particular company, Reunert's been around. It's one of the oldest listed companies in the JSE. It's been relatively staid. It's got a number of very mature businesses, and what they've been able to do is take the cash flows from those mature businesses and to reinvest in what they call early life cycle businesses, one of which they're focused on is renewables. So it's really quite interesting how the cycle has moved towards the industries that they've been aligning themselves with. We engage with them between sets of results not too often, but we happen to engage with them relatively recently. And the demand they're seeing for their renewable offerings, be it through the cablings business or the solar panels, through the battery storage businesses, it's quite remarkable, as you'd expect, given the panic that everyone's going through right now to try and find solutions for your domestic renewable requirements, or if you're a business, for your corporate requirements. Every single company, there's a whole lot of results out this morning. Every single company is alluding to what they're doing to get off the grid. And so that the ecosystem of renewables is just so well placed, and they are what we can determine one of the purest ways to be able to play that.
Oh, that's interesting. If you were to say to any South African 3, 4, 5 months ago, if you could invest in something which is going to give you a benefit if Eskom gets worse, I think most South Africans would have said, I'm with you. But not too many of them knew that Reunert was the way of doing it.
Possibly.
But that's what the stock market is, isn't it? By
their own admission, it's been you've still got the dominance of the traditional businesses. By their own admission, they've invested in these early cycle businesses. They've allocated capital smartly, they've made some good acquisitions, and combined with their traditional portfolio and the potentially fast-growing vector they've got into, we think it looks pretty interesting. And the reality is, Alec, we spoke about it last time. I updated the numbers in January again. These businesses are cheaper. They're really, this business...
Still fire sale?
No, but adjectives are weird. I'm wary of adjectives.
They're good for headlines.
Yeah, so what we did, I'm chatting maybe too much, but what we did in January was we are so... the macro environment so globally is so ever-changing and complicated, and there's lots of big headlines that go around, and domestically it's even more noisy with all the issues that we discuss on a daily basis regularly. We all know them particularly well. So the macro discussion when it comes to building up a asset allocation portfolio is very complicated. So what we try to do was take it down a step and just look at companies. And for the purpose of our exercise, we stripped out mining and we stripped out Naspers and Process because of the notoriously difficult predictability of those particular companies. And I say that with respect, but that's our view. So let's look at financial industrials, which is slightly more predictable. And we did an exercise of earnings yields, we looked at the bond yield, and we looked at where we think the earnings of those 15 or 20 companies could be in 3 years' time. And the compound return that we get from a relatively simple exercise out of that reasonably large sample of companies, household names, some small, some mid, some very big, it completely dwarfed what we think we'll get out of alternative asset classes like fixed income, and it would be significantly ahead of inflation, which is our ultimate benchmark. So
how dwarfed? Just maybe give us
we think that
quantified
the
more.
bond yields bond yields for the next 3 years, investing in the bond market would give us a return. I think the number's in the order of 11.5% compound for the next 3 years, assuming our bonds behave like we think they will, that yields are too high in this country. And that's a reasonably big assumption in many people's view, but that's our assumption. And in that environment, we would think with bond yields falling, with the ability for these businesses to slightly re-rate, and with a very modest growth in earnings, which will be ahead of inflation, but maybe it's 8 to 12% growth in earnings, coupled with high dividend yields, we think that you can get materially more than your 11%. So the cost of equity would be 16, and this sample of companies would have given us materially more than the cost of equity. So I just think that when you break it down like that, because ultimately when you're building any fund, be it a balanced fund or an equity fund, it's a portfolio of investment opportunities, and it's those which ultimately make up the asset allocation. And when you break it down like that, we just think that the appeal of many of these businesses is extremely compelling.
I spoke with Sean Pesh yesterday, and he reminded me that he, like you, is an active fund manager. So he said, look, I can't tell you about stocks that you should buy and then hold indefinitely, because the definition of an active fund manager is when they're cheap, I buy, and when they're expensive, I must sell. And I guess it's the same thing from your perspective. You would not be buying a stock and holding it forever. But how much would the JSE have to go up by for this group of companies that you've now identified, the SA Inc. companies, Roinet, ACI, and a bunch of others. How much would they have to rise by to get to fair value or even overvalue?
Okay, that's a good question. In broad brushstrokes, they would need to rise from today's levels. We would think in excess of 20%. I don't want to get inflammatory, but certainly there's some attractive, very attractive positions or evaluations. And I think it's taking a step back. It is dependent upon us generating some growth as an economy. All bets are off if the lights are off. I mean, I think that's a reasonable conclusion to draw. But it's not our central view. I mean, I've gone through a whole lot of economist updates that come out in the last couple of weeks, pre-SONA, pre-budget. They'll be updated again post the budget. And this, despite the load shedding impact of load shedding, it's not an economy that's going to slip into material recession. So if you've got a reasonable nominal growth story at an economic level, good companies, of which many are listed in the JSE, they've demonstrated themselves over many cycles for decades in many cases, the ability to perform well in difficult economies. And we think that they'll be able to deliver real earnings growth, which is anywhere between, as I said, 8 to 12% compound for the next 3 years in many cases. And that in itself gives you some sense of what the kind of returns you could expect from these businesses over time. That starting yields are high, dividend yields are high, and the prospects of what we think should be a re-rating is long overdue. I mean, to be fair, I've been banging this drum for too long now because we've stuck in this very cheap, very high bond yield environment, very low PE environment for many companies for a sustained period of time. But if the overall backdrop is okay and we muddle through and the economist forecast and GDP are correct, then I think it's exciting.
There's another dirty secret about South African investing or investments in South Africa, and that's the fact that international companies find it too high risk to invest here. The fact that many South African businesses are putting their money elsewhere means that those who are left, almost by a process of elimination, will have an easier run than had they been subjected to massive foreigners competition and indeed other competitors coming through. Does that play much of a role in your thesis?
Possibly. I think in certain sectors that would definitely be the case. I think, we've got oligopolies is the word often used in terms of the banking sector. I think it's changing now with some of the new incumbents. So I think the life insurance sector has been pretty dominated by a few players. Retailers, again, we get a similar thesis. So possibly. I think, it boils down to the fact that the cost of capital of investing in this country is high. And that's...
Risks are high.
Well, yeah,
well,
they are, but businesses generate good returns. And I think they are perceived to be high, but actually these businesses have done a good job over long cycles of being able to generate good returns on their capital. It's a broad brushstroke generalization. There are many that have struggled, and there's a couple of big ones that have announced results today that have really struggled to deliver returns on equity. But I'm talking about broad brushstrokes. The companies that would have been in that sample size of 15 or 20 that I spoke to, large number of those have generated good returns over long periods of time. The inability of foreign capital to arrive here is an interesting debate because we are of the view that capitalism sniffs out opportunities. If the valuation discrepancy is too high, capitalism finds a way to equalize those. It's what's perplexed us most about the bond market because the bond yields have been so high in our country and so low in the rest of the world, and they haven't moderated. And again, there could be a litany of reasons for that. But ultimately, over time, we think that these arbitrages, for want of a better word, do get worked out. And if our valuation discrepancies to the rest of the world remain so wide, we think that there are levers to pull to unlock some of that value. So.
When you look 3 to 5 years down the road at the whole electricity demand and supply ratios, given that we're sitting in Cape Town, the mayor of Cape Town says that within 2 more years, Cape Town will not have load shedding anymore. because of the initiatives that have been taken here. And he's not the only one in the country who's doing it. Many of the companies are doing that as well. How do you think that's going to change the investability of South Africa, and in particular this group of companies that you have in your portfolio?
Look, I mean, it's a net positive. It comes with other issues, and that Eskom then becomes it's got its own problems in it. There's no revenue, but if revenues decline by that much, but our focus very much is on 24/7 power, and if we can find ways to get around that, then all the better. We would all be in favour of that. I think with that comes a significant amount of fixed capital investment, which needs to happen. The likes of yourselves and ourselves at a personal level would need to potentially invest in solar solutions for home, which taps into your mortgages to try and credit extension grows. Credit extension has been one of the missing links in this economy for so long. So I think that the landscape will change dramatically. Speaking to Rowan, they can see it happening very quickly. Small businesses, what they're seeing, your average SMME is finding solutions. It's happening so quickly behind the scenes that they think that this will happen. To your point, I think it'll happen in the next 18 months to 2 years. Many businesses, and I don't want to use the word most because I can't do that. But certainly many businesses, it would appear, SMEs, medium-sized businesses, large corporates are going to be largely self-sufficient, and it's a good place to be.
And it's a forgotten figure as well. Corky Koeman this week was telling us that the credit extension figures for the last quarter are up 12% year on year in South Africa. Suddenly, out of nowhere, people are borrowing again. And he puts it down to exactly the point that you're making now. That if you don't have power as a business or even as a resident and you're trying to work from home, well, it's a no-go. So mark a plan.
It's been the missing link. Alec, we spoke about it. We might have spoken about it last time. For 13 years, and Corky would have alluded to this many times in your shows over the last decade, but for 13 years, this country grew consumer credit below inflation. Rates are high, confidence is low, and what happened was that ultimately consumer balance sheets got stronger and stronger. So we have the capacity at a macroeconomic level. My sense is one has the capacity to increase leverage, and
take on more debt.
Take on more debt, and that's constructive expense, because if you're borrowing money to get off the grid, you're saving on your electricity bills. It's not. I mean, it's constructive use of debt. You're not going out to buy
a second car, a third car, fourth car, jet ski, etc. Consumables.
Exactly.
But that is interesting as well. If you now go forward on the government finances perspective, and this is the week of the budget, and we will hear that once again the Treasury got a lot more money than it anticipated, than it had budgeted for, around about 10% more, 80 to 90 billion rand extra that came in. From your perspective, do you even look at things like that, how that's being allocated, or are you more interested in what's happening on the ground with the companies?
So, I mean, it's obviously relevant for all of us as South Africans, and we will read a lot about it in the next few days. But traditionally, no, one would not spend too much time. There is a whole industry out there that does focus on that, and that's the one I alluded to earlier. The macroeconomic forecasts take that into account. And it's an area of discussion one prefers not to go into, which is why I took that whole exercise of this macro asset allocation, taking it down from that sort of economic macro level down to a bottom-up stock level, and just see what came out of that exercise. Because, there's lots of moving parts. It's very noisy. Sona... it's not a
we know that was noisy.
Yeah, it's very noisy. And so we just prefer not to go down that road of politics and
a couple of stocks that I'd like to ask you about just as we close off, because they're in the BizNews portfolio, thanks to you, Mr. Vintcent. ACI, Reunert, Absa are three stocks that Glencore, four stocks, in fact, that we have in the BizNews portfolio. Are our community well served by holding on to them?
Yeah, look, we think so.
All four of them?
Yes, for sure. On the first three, Glencore Absa, I think, is we really like it. It remains a very key holding in the portfolios. Reunert we've touched on, and ACI it's been frustrating for a sustained period of time. But we think some of the dynamics in their industry is shifting a little bit post the sort of the Ukrainian war. Europe seems to be opening up, and the demand for explosives, which is a key part of their business, is obviously, we still think, is pretty robust. Glencore is well positioned in the one commodity we do like, being copper, and the growth that one sees in the copper market for the next number of years. The counter to that is that the coal market, which has been a material contributor to their earnings, has rolled very quickly, with all the good things that come from falling energy prices like coal and gas. But for them as a business, we still think the cash flow generation is high, the valuation's not too stretched, it's probably it's the purest way in South Africa to play the copper market. Anglo's built in their copper, but it's slightly more exposed in Glencore. So yes, all four, particularly the first three. As I said, we removed mining and Naspers out of that exercise for this particular reason. There's so many variables and moving parts. But certainly the first three, ACI, Reunert and Absa, are businesses that we really believe, looking back in 3 to 5 years' time, one would have been handsomely served by owning those businesses.
And the final one I'd like to talk about is Spar. Now, often when a company hits a wobble, as Spar has done, it is a good time, if it's a solid, strong company, to be investing in for the long term. It's in your portfolio, in one of your top 15 stocks, a high conviction holding there. What do you make of the ructions that have been going on at Spar, or is it a question of this too shall pass?
Extremely disappointing, the developments that played out in the news over December, January. Some great investigative journalism that uncovered a lot of those issues, I think, but disappointing. The materiality of all those issues in Spar still needs to be debated, and we're not necessarily sure how material all those particular incidents are in terms of the overall group. The bigger issue to us was the misallocation of capital in some of their new areas in parts of Europe, which have been underwhelming. But maybe history will judge those to be good investments. But in the early stages, it just looks pretty underwhelming. But we've taken an increased liking to it at these lower levels because, firstly, food retailers are typically traded at a much higher rating than your discretionary retailers, and a significantly higher rating than other domestics like financials. Shoprite's shown you. Shoprite's been a premium rated businesses for all the right reasons for a long period of time, and it remains extremely well valued, fully valued. Yet Spar got to a valuation metric compared to Shoprite, which is nearly 50% lower. And I guess it's that appeals to us. We do spend a lot of time worrying about valuations, and that was the appeal to us. Food retailers are typically more defensive than others, obviously, and it's that the combination of this very low multiple.
Andrew, a stock in your portfolio that I think many people are now eyeing because it's fallen so far is Spar. It's one of your high conviction holdings, but it has been through a little bit of the mill recently. Is it a time to buy when there's blood in the streets?
It's been such a difficult one. I mean, the issues that were uncovered during December and January were most disturbing from a corporate governance point of view, and they seem to have made the appropriate steps to rectify those. Why we like Spar is I think that food retail industry is typically a very highly rated sector, as evidenced by Shoprite, which now trades at multiples which historically would have been, well, they're extremely high. They're high teen multiples, and for all the good reasons, it's been a standout performer in that space. Shoprite got to a valuation which was almost 50% of the Shoprite. Spar got to the valuation almost 50% of Shoprite. It's a good business. It typically does quite well when it's a distribution business in many ways. When fuel prices fall, it typically does reasonably well. They've made one or two, which on the face of it look like disappointing acquisitions in Europe, but in the scheme of things, we think that the Spar South Africa business is potentially reasonably well placed. And you're buying this business on a single-digit multiple. You certainly were. And we think that valuation discrepancy was too high, which is the reason we, I guess, bought a few more.
Can we, though, having missed the boat at the very lows, can the rest of the business community go in?
It forms part of that exercise we did. I think that's one of those companies, I think it was one of them, but it was certainly, if it wasn't, it could have been. It was one of those companies that we think the prospects for good 3-year IRRs from today are very much exist in a company like Spar.
Andrew Clucas is with Andrew Vintcent is with ClucasGray. I'm Alec Hogg from BizNews.com.